Just like when you go to BJ's and you buy, a big thing of toilet paper for half the price, it's the same with a portfolio. You're going to get a discount when you buy in bulk.
Welcome to the Fully Funded Show. Whether you're a capital raiser, deal sponsor, fund manager, or LP investor, we've got the insights you need for investing success. Join Sam Silverman each week for expert interviews, insider tips, and strategies to fully fund your ventures. Let's go!
All right, we are back with the Fully Funded Show, this time with Andrew Freed. Andrew, why don't you give the audience some of your background?
Happy to. So when it comes to my background, I found real estate back during COVID when I read Rich Dad, Poor Dad. And prior to that, I did the normal American dream where I got a good education. I got a six-figure job. I got a nice swanky condo in the city in Boston, right? I essentially made it. But when COVID came, I came to the realization that maybe I have 12 months of reserves. But at the end of the day, I still have to go crawling back to that job. And my foreseeable future pertained around me being in that job for 30 to 40 more years, which scared the living hell out of me. So at that point, I really decided I had to make a change. And what I decided to do was 80% of my net worth was in that one-bedroom condo I bought. I literally took a HELOC on that condo and utilized that to start buying multifamily in Worcester, Massachusetts. I started house hacking. Then I found joint ventures, got up to about 30 units with my own money, right out of my own money, and then figured out how to use OPM or other people's money. And as of today, 3.5 years later, I'm at about 190 units with another 50 units under contract. And in regards to what I do is I'm an operator, right? I operate my deals. I self-manage a lot of my stuff. Additionally, I also raise capital over the past quarter. Over the past 2 quarters, me and my partner raised over $5 million. So that's kind of just a little bit about me in a snapshot.
Yeah, and I think it's a really relatable story, right? For people listening who may, have a great six-figure job, multi-six-figure job, and for them, they see their future, right? In terms of the next few decades at the same job, working there, a lot of their net worth and kind of dependency relies on that job. So I think it's a really relatable story for you, kind of shifting from, okay, I have a lot of this net worth in my house. And how did you decide to go take a HELOC on that? I think right now, a lot of people are stuck in a position where their return on equity in a project, in a home, is really bad, right? So looking to free up cash. That's going to walk us through that thought processing calculation from there.
Absolutely. I mean, it comes down to one key concept when it comes to building wealth. It's the concept of arbitrage, right? So the concept of arbitrage is more or less you're borrowing money at one rate, you're transitioning the money into another asset for a higher return, and you're collecting the difference, right? So say, for example, back when I had this line of credit, rates were 3 and a 4, right? I was borrowing at a 3 or 4%. I did take $65,000 and threw it into a syndication as a limited partner, and that syndication offered a 15 to 20% return. So literally from me moving money from one pot to another pot, I collected the delta of 12 to 15% return on that deal, which that deal actually sold a year later for an 89% return. And I literally took that money and bought a 5-plex with it. So when it comes to utilizing lines of credit and utilizing debt, the main key point that you have to keep in mind is if you're borrowing this money, whatever you're transitioning it to, it has to have a much larger return so you can collect the difference.
Yeah, really simple and powerful concept too. If you can borrow money at a certain amount and earn far above that, right? Like your arbitrage is a spread between that. So really powerful. And we're kind of looking at you getting into these smaller type deals that you've done, right? A more portfolio driven based on your location, right? I can know the markets that you're in fairly well, where it's not, you don't have these products that are 200 apartment complexes that most indicators go after. And I actually think there's a lot of value in these smaller portfolio off market type deals. So help us understand the market that you're in and why your strategy kind of aligns to this versus going after these huge deals that may not be in your given market.
Yeah, that's a fantastic question. And Massachusetts is a very unique market, right? During the past couple of years when other markets were seeing price declines, Massachusetts was actually seeing price increases, right? And there's many different reasons for that. I mean, Massachusetts, it's one of the most expensive states and it's one of the most regulatory heavy states. What that translates to is it's very hard to complete new construction, right? So what that does is that actually restricts the supply of housing in our market while the demand is going up, resulting in the prices actually increasing during down periods, right? Additionally, Massachusetts is a growing market. I believe their population is growing 1 to 2% every single year. So it's a growing market, limited supply, higher and higher demand. So Massachusetts is a really unique market, and I think a lot of people avoid Massachusetts for many reasons. But like one of the main reasons they avoid Massachusetts is tenant friendly, right? And usually syndicators and operators, like before they even look any further, they just cut it off and like I want a landlord friendly state. But I welcome the fact that this state is tenant friendly. First of all, it reduces competition, right? Less operators in my market. And if you know how to operate in this market, you can be extremely successful. It's literally all about emotional intelligence. It's all about creating win-wins, right? Like, yeah, I can go through the eviction process. I can wait 3 to 6 months to get somebody out, or I can offer them cash for keys. Or, I can do other strategies to get them out and come up with a win-win scenario. Maybe we meet in the middle with the rent increase, right? There are other strategies you can utilize to be successful in this market, which I love, and I love the fact that other people don't see that opportunity.
Yeah, I totally agree. And I also feel like it's a place too that because of the, on the outside looking in, it's less attractive to larger players coming to the space and the product you're competing with. Like I think there's opportunity then where you can go buy deals actually off market, right? From sellers who may lack a level of sophistication. So help me understand on your end, like how are you going out and finding these portfolios, these properties to go buy? Again, and what's your strategy there in doing so?
Yeah, I mean, so you bring up a lot of good points in the fact that Massachusetts doesn't have a lot of large buildings, right? A lot of the buildings are small buildings like 3, 4, 5, 6 plexes, right? And if you're trying to buy 40, 50 units, they're encompassed in a portfolio. Maybe a seller's selling 5, 10, 12 properties all in one foul swoop. And when it comes to the housing stock, most housing stocks, across the Sunbelt state, they're 1970s, 1980s, 1990s construction. All of our multifamily, specifically in Massachusetts, New Hampshire, and around the New England area, they're like 1880 to 1920 construction, right? And when I say that, people get scared. But at the end of the day, like that doesn't scare me because first of all, the foundation on a lot of these buildings are constructed way better than what it was like now. Second of all, literally, as long as you're like reviewing the CapEx in the building, it doesn't really matter. Like that property went through 5 roofs already. That property went through 5 pairs of windows. That property's electrical's been done 3, 4 times over. The plumbing's been done 3, 4 times over, even the foundation, right? So you literally just have to go through the property and see like what is the status of the CapEx, because it could almost be as good as a 1990s build if all the CapEx has been updated recently. Right. And to your point, how you find good deals. So the real good deals you find in Massachusetts are portfolios. You're buying a bunch of different properties, all from the same owner. And just like when you go to BJ's and you buy, a big thing of toilet paper for half the price, it's the same with a portfolio. You're going to get a discount when you buy in bulk and you make it easy for the seller. And that's exactly the strategy me and my partner have utilized. And we've closed on, I think we're going on our 3rd or 4th portfolio right now. And I just want to mention, the really good thing about portfolios, which not many people talk about, is the fact that a lot of times you get a mix of residential and you get a mix of commercial multifamily. And the great thing about residential multifamily is you can sell it for a higher price per unit because you're targeting those FHA buyers, those house hackers, those residential buyers, right? So I can buy a portfolio, sell off the smaller stuff, get a max price per unit, stabilize the larger stuff and do a refi on the larger stuff and get a lot of the principal back to my partners, right? So there's a lot of different exit strategies with portfolios as opposed to one property where there's very, maybe you have 1 or 2 exit strategies.
Sure. No, I mean, it makes a lot of sense too. And also they're more liquid as well, right? And we're kind of looking at going to go sell off a 3 or 4 or 5 unit, complex versus having to go sell a, $20 million plus complex. So I think it allows for a lot more liquidity options and just optionality of how you're going about, running your investment structure. And moving to investment structure as well. I know we've talked about JVs and syndications. Help me understand kind of how you've structured joint ventures in the past and kind of why you've chosen to go that route versus the formal syndication route at times.
Absolutely. I just want to give one pro tip when it comes to buying portfolios. Always, always, always negotiate with the lender for a partial release clause, meaning you have the ability to sell off properties one by one while keeping the entire loan intact. That allows you flexibility to get investor capital back without having to do a refi in the entire portfolio, right? So I learned that early, but I would just definitely recommend if you are going after a portfolio, make sure to negotiate that with the lender up front. Regarding your question, I mean, that's a fantastic question in regards to JV versus syndication. So when it comes to syndications have a large sunk cost, right? You're paying $30,000, $50,000 in legal expenses to make sure it's complying with all of the requirements, right? And that's great and all, but when you're going for a purchase price property of $1 million, $50,000 is going to kill the cash on cash return pretty dramatically, right? So the syndication model doesn't make sense a lot of times for these smaller purchase price properties. So when I'm buying like a 6, 7, 8-plex property, a joint venture model makes much more syndication, much more sense. I simply open up an LLC. I include my partners as members of the LLC, and we close through the LLC, right? And to your point, the key with a joint venture versus a syndication is a joint venture, all of the members have to have an active role. That could mean a member could approve expenses above $5,000. That could mean that they're taking some asset management type responsibilities, but they have to have an active role in that project. Otherwise, if they're completely passive and just accepting paychecks in the mail, that is considered a syndication, and technically you should go, through the syndication model, you get an SEC exclusion. So that's kind of the real difference, right? So for these smaller multis, I bought 6 plexes, 10 plexes with partners. I'll give them an active role, and we'll do those models via joint ventures. And then these larger properties, these $3, $4, $5 million properties, and can actually absorb the sunk cost of a syndication, we'll go the syndication model that route. Another main determinant is how many members are a part of the structure, right? If I have 20 investors, that can't be a joint venture. That is obviously a syndication. Versus I have 3 investors, like I could do a joint venture on a $5 million property if I give them an active role, and it's less paperwork, easier to manage, and it's just a lot more fluid in getting it closed.
Then with those joint ventures, right? Say you're structuring a deal, whatever the purchase price is, and you have 3 main investors, maybe including yourself, maybe you're the 4th investor there, right? How would that work in terms of structure that you use? Do you use a similar structure such as a pref and a split? Or what does it look like for you? And if so, what do those numbers typically look like?
Yeah. So to your point, in a joint venture, it's very similar model in the fact that the people bring the money, get an 8% preferred return, and then everything after that split 50-50, right? That's how I normally set it up in a joint venture and or a syndication model. It's just the money brought to the deal gets an 8% pref. It could be my money. It could be my partner's money. Doesn't really matter. Then everything after that is split 50-50. We do build in a acquisition fee because we got to keep the lights on. We got a whole team of about 7 or 8 people to support, right? So we do have an acquisition fee, and a lot of times we do the project management in-house. So we'll pay the 7 to 8% property management fee directly to us because we're doing that, right? Or if our investors aren't satisfied with us, we just simply move the property management to a third party and give them the 7 to 8%.
Got it. Yeah, and it's interesting too from what I've seen kind of in this conversation, other conversations, that as an operator, you can typically get more equity in a JV structure versus in a true syndication, right? Very uncommonly in larger syndications do we hear people doing a 50-50 split, which I think also kind of highlights the velocity of money you can have in these smaller type projects too. But a lot of these larger deals, you need a level of market uplift to go get to your numbers, right? In terms of organic rent increases, right? Things pushing in that sense. Whereas these smaller projects, your time to execution can be far more quick. So kind of walk us through what a typical project looks like from the day you close to actually, achieve the business plan. Is that 12 months, 36 months, 60 months? Like walk us through what that timeline typically looks like for yourself.
Totally. So our main goal, and a lot of times it's the same exact business plan for every property we buy. Our main goal is to find a property where the price per unit is, 20, 30, 40%, where the average price per unit is in that particular area, and where rents are 30 to 40% below market. And at that point, we go in there, we get rents to market, and our plan is to do a refinance within 12 to 18 months. Get the rent up on the property. We usually incorporate construction funds from the bank, and we usually plan on doing a cash out refinance within 12 to 18 months, getting our investors back as much principal as possible, preferably all of it. And then at that point, that removes the pref hurdle, and it's just a 50-50 split from there on out. So that's kind of how we structure our deals, like post-close. And a lot of times we're the boots in the ground. So we're the ones actually meeting the tenants. We're the ones negotiating the rent roll. We're the ones collecting rent. We're the ones, doing the construction management. Like that's me and my team. And that's how we're able to expedite the stabilization process, because we really own that and we don't give it to a third party.
Yeah, it's really smart. I think your, execution risk goes down when you're buying properties that are so far below market that you still have the level of value add from pushing rents, and also controlling the process too, from having all of it in house that you're working on those projects for, from management to construction management, etc. Right. So really shortening that time horizon. So I just want to make sure people are listening to this and have this in mind, is that you don't need to go invest in massive properties to go realize a solid return. Right. I think your risk is less so in smaller projects like this, for the reason that if a deal is from an 8% pref and 50-50 is modeling to a similar return as an 8% pref and a 70-30, that person who is doing the 50-50 project, they have more margin for error to go get to your return metric, because they have more of the deal they own themselves. They can always move around if they need to get to that return metric for the investors. The more lean a deal is in terms of for the GP, right, for the operating partners, the tighter margin of error they have to get to those return metrics. So small deals can still be really quality returns and also actually help with the velocity of capital. So, just all of this again to highlight, the big deals are not always needed, right? You can make the same money investing in a fourplex, a 2-unit deal, or a 200-unit deal,
And
right? It's going to all things you think about as an
and
investor.
I personally like the fact that me and my team, we take the property management in-house, because that allows us so much flexibility. Like, say for example, the property is, not going in accordance with the business plan. We always have the ability to take from our property management fee of 7-8% and give that to the investor as the pref, right? So it offers us way more flexibility to make the investors whole and keep them happy throughout the process.
For sure. So now let's kind of start shifting gears to, how you actually go about raising capital. So kind of walk me through what that process is like. I know you highlighted you and your team have raised over $5 million the last 2 quarters. Like, help me understand kind of what that process is for you launching a deal, and also how you go about effectively building your investor list and making connections that can actually provide you with capital to keep scaling.
Yeah, I mean, those are all real questions. I mean, honestly, it's a multi-prong approach on how I build my investor list, right? So I host one of the largest real estate meetups in Worcester, Massachusetts, which is the second largest city in Mass, right? So I build myself as a subject matter expert just by hosting that event. I've gotten deals brought to me. I've gotten capital raised through this event, right? I've met big players through them being guest speakers, right? And them bringing me deals and want to partner on things. So that alone has really expanded many aspects of my business. Along with that, I go on as many podcasts as possible. And I really like podcasts because they establish yourself as trustworthy and likable without having to spend that actual one-on-one time with investors. Investors can literally spend 5 to 10 hours with me listening to my podcast, and I don't have to physically, meet coffee with them, which just expands my reach and allows me to reach that many more investors. Additionally, whenever I go to meetups, I always make it a point to get my electronic business card and take down every person I talk to. And then at the end of the night, I simply send it off to my virtual assistant. They put it in my CRM, follow-up boss. And then from there, then by doing that alone, I've built an investor list of around 2,500 people, right? And then I combine that with touching the investor on a consistent basis. So me and my partner, we normally do monthly newsletters going over where all of our projects stand, going over meetups, going over any off-market properties we have, news articles that we like to point out to people, investing tips. We offer it's literally like a 20-page document that goes over all of the value add, and people can get so much value from that, either finding deals off market, investing opportunities, finding out what the status of the current deals are that they're invested with us, right? So that alone has allowed us to raise over $5 million, as I mentioned. And we normally, all of our deals get raised within a couple days.
Yeah, really cool. I mean, it really just highlights that doing the work up front allows you to go push deals out to your list and, give yourself the confidence you can go close them. Therefore, giving the confidence you can go keep making offers on properties and be really aggressive. So I like what you're saying specific to the, positioning yourself as a subject matter expert, right? A big thing is making sure people know who you are, what you're doing through, podcasts, through hosting events, which especially being local in your market and structuring JV deals, likely very appealing to go partner with folks in the area, right? Additionally, kind of, allowing yourself to go borrow people's audiences. I think podcasts are great in the sense that you go get to tap someone else's audience, share your story, and allow people to go form an opinion of you. Like, I think it's a great strategy where, that really helps shortcut the timeline. So podcasts are, in my opinion, good for two things, right? One is borrowing a network or giving yourself access to a new network of people. But more importantly, after those podcasts are already aired, right, or different, content you've shared is already aired, people can go progress in that funnel deeper with you, right? Say they talk to Andrew, like, hey, Andrew seems like a decent enough guy. I'm going to go, search his name in Spotify, search his name in Apple Podcasts, listen to 10 shows he's been on and see, okay, do I actually like this guy? From here, that can go help me understand, do I want to invest with him, right? Do I like him? Do I not like him? Do I trust him? Do I not trust him? Much more quickly than Andrew having to go talk to that same person 10 times in the conversation.
Yeah. And I mean, to your point, going in other people's podcasts, you can leverage the audience that they built up over years and years and years and simply just jump on the podcast and spend an hour of your time, right? So I hear from a lot of capital raisers, a lot of new investors, like, should I start a podcast? Like, my answer to that is, like, it depends on what your goals are, right? If your goals is to invest into network with large players and really kind of get to know the real estate community, then that's great. You get to network with guests, you get to invite people on, you really get to know them. But if your real goal is to really spread yourself and really get known in the industry, I highly recommend you become a guest and you leverage other people's hard work of creating a podcast for 2, 3, 4 years. And I simply just jump on, spend an hour of my time and leave, right? I could do 20, 30 podcasts. I could probably touch, hundreds of thousands of people versus starting my own podcast, staying at it for 2, 3 years and only getting a reach of a couple thousand.
Yeah, it's an interesting point, right? Like, I think it depends on who your audience is as well and how you go structure the podcast too. So for example, what I see a lot of people do who are looking to go raise capital for, say, real estate, they make a show all about real estate. And in turn, who listens to it? Active operators. It's also very unlikely an active operator wants to go invest into your deal, right? Because you're cash strapped, right, for your own projects. You're investing heavily into your own deals. So it'll help people get to know you better. It'll help people understand how you think and operate. But really important to dial in your audience with who you want to go speak to so that if you are successful, it's successful in the right way. So totally get what you're saying there.
Yeah. I mean, just to add to this point, I mean, podcasts are also a fantastic means for social media content, right? Like, I could take this podcast, I could cut it up into 5 clips. I have a week worth of content right there, right? So, like, building your social media content is incredibly important when it comes to raising capital. And podcasts are a multi-pronged approach. It builds likability and trust. You create social media content, right? Like, sometimes people will even bring me deals through these podcasts. So they offer you so many benefits other than just raising capital.
For sure. So Andrew, on your end, kind of what's next for you going forward?
So what's next for me is me and my partner, we're planning on closing our 300th unit by the end of the year. And my 10-year vision is I want to help 10,000 people reach financial independence. I want to syndicate 10,000 units. I want to actively own 500 units. I want to travel to 100 countries, then write a book. That's kind of my 10-year plan. So that's kind of where I'm at right now.
Very cool. Well, hey, before we hop off here, what's the best way, kind of how and why should listeners reach out to you?
Yeah, I mean, people can find me on Instagram at Investor Freed, Facebook, and LinkedIn at Andrew Freed. If you're interested in multifamily, interested in the Massachusetts market, the Northeast market, definitely feel free to reach out. That's my bread and butter, and that's where I own a majority of my units.
Cool. Andrew, thanks again for coming on today.
Thank you for having me.
Thank you for tuning into the Fully Funded Show hosted by Sam Silverman. If you are enjoying the content, let's take your journey further in the Fully Funded Mastermind. The Fully Funded Mastermind offers more than just insights. It's a mastermind community designed to solve the real challenge of raising capital. By joining, you gain direct access to strategies, coaching, and a network dedicated to turning your financial goals into achievements. Don't let capital raising be a barrier to your success. Visit fullyfunded.capital to explore how our mastermind community can pave your way to financial growth.
Thanks for tuning in to the Fully Funded Show. If you enjoyed today's insights, hit follow. Share with your investing pals and drop us a review. Connect with us on social media for bonus content. Your success is our mission. Keep those funds flowing. See you next time.